Can you keep pace with the evolving ESG landscape? The 2024 certificate in ESG investing has been updated with the latest research and insights to help you become the in-house expert at your organization. Register today at cfainstitute.org/ESG certificate. That's cfainstitute.org/ESG certificate.
Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Rob Rowan. Today we're talking with two people at the center of the ESG debate. We're going to discuss ESG Backlash, some of the policies that are coming down the pike, and their long-term views. We're going to start with someone who's been a speaker at our very first ESG event way back in 2018, the Reverend Kristen Snow Spalding. She leads the Ceres Investor Network and all Ceres Investor initiatives. Prior to joining Ceres, she served as Chief Deputy Treasurer under California Treasurer Phil Angelides and Director of the Treasurer's Environmental Financing Authorities. She holds a BA from Yale, a JD from Hastings College of Law, and a Master's in Divinity from Church Divinity School of the Pacific. Stephen Rosting is our second speaker today. He is managing director at Ceres in the Ceres Accelerator for Sustainable Capital Markets. By the way, CFA New York members, you can Google this. It's exceptionally interesting. Got some really great blogs on it, so go check it out. It's Ceres Accelerator for Sustainable Capital Markets. I enjoyed it when I was doing prep for this. Now, he has a lot of experience in many different parts of the energy markets. He was one of the founders of Citizen Energy Corporation. He also founded Environmental Futures and ran the New England market for Constellation. He got his BA from Williams College and his MBA at Northeastern University. So thank you both for being here on the podcast today.
It's our pleasure.
I'd like to start with some things that are in the news about the ESG backlash. We've had a lot of ESG news over the last couple of weeks here as we were recording this on March 14th. 1 week ago, we had something that seems like everyone's been waiting forever from the SEC. But there's also a lot of proposed state laws, even some protested investment management firms and asset owner organizations. So what is your investor network reporting to you about all those things right now?
So my network of investors includes large multi-asset class managers, big pension funds. It includes specialty managers, those socially responsible managers, those who are really focused on investments in climate solutions and other sustainability products. So it's a pretty diverse group. And I'm hearing different things across the network. I would say the loudest and maybe clearest voices come from the largest investors in the network. And what they're saying is incorporating climate and other sustainability risks into their investment decision-making is as important today as it has ever been. Look at the dramatic weather events. These are issues that impact the bottom line. Investors need to understand these issues and incorporate them into every aspect of their investment decision-making, whether they're setting up their portfolios, choosing how to weight one security over another, or engaging with the companies that they hold. There's a full range of sustainability issues that are important to them, and they're core to their obligations to their clients and their beneficiaries. That's not going away. I think there is a lot of noise and media hoopla about ESG, and most of the public doesn't even know what ESG means. So I think we have to keep saying, we engage around these issues because they're important to financial performance. And that's really what I'm hearing from my members.
Okay. And are most of them looking as far as scope 3 now, or are they 1, 2 mainly?
So I think that's a nuanced question that it depends on every investor.
Right. Well, it depends on what scope 3 you say it is. Yeah, it's one of those things. Yeah.
It is one of those things. So I think what the investors are asking is it material to the whole portfolio? So with heavy emitting companies, they're very concerned about scopes 1 and 2. But in many cases, really the scope 3 emissions are what matter most. So if you take, for example, the automotive sector, manufacturing by definition has some carbon in it. We're worried about where they're getting the energy to do that manufacturing. But the real question for investors is, are these companies prepared to move to electric vehicles? And that's a scope 3 question. That is where we know A company is going to create value in the long run if they're positioned for the economy of the future. So I think the answer is it depends on which investor you ask, and it depends on which sector we're looking at. But certainly scope 3 is important.
Yeah, so in your opinion, because you've been doing this for some time, it seems like the due diligence is actually more complicated now.
Well, I think, when I talk to the analysts inside these investors, they say, yeah, there are some trends that we have to address, but it's not that we've never thought about these issues. If they're a core fundamentals analyst, then they're used to dealing with complexity. They're used to dealing with sometimes incomplete data, and it's the expertise that the analysts bring that really help the investor to stand out, to produce alpha, and to manage risk. So I think there are new issues that have to be addressed, and there's certainly new data emerging, but I don't think it's more complicated than anything they've dealt with before.
Rob, I'll just add that we're seeing dramatic changes. First, we're seeing laws both in this country with the SEC and regulations, but laws around the world, climate disclosure. So there are 15 countries that are actively considering that now. Europe, obviously, just China established it. It's happened. That's a worldwide trend. And like any other thing, as you can't manage a problem if you can't measure it. So it's a foundation. We're also seeing obviously dramatic increased risk. Number of fires, floods, tornadoes. NOAA said in the 80s, we had $1 billion storm every 4 months. Last year, we had one every 2.5 weeks, and lots of other facts. We're also seeing greater opportunities between the Inflation Reduction Act, infrastructure, that there's lots of opportunities to make money on these areas. So there's greater regulatory areas, there's more risk, more opportunities. And unfortunately, we've seen in the last 18 months, 24 months, more polarization. That the conversation about, we're one of the only countries where there's still a minority, it's still a small group who are saying, is climate change really human-made? And so that's kind of getting in the way of really getting to the real issue.
This backlash seems to be in almost every sector of our society right now. It's not the only one, but what has Sarah's response been to the backlash? How have you been advising people to talk about it and handle it across all of your constituents?
Yeah.
I'll hit that to you. Yeah.
Please feel free to start.
I was just going to say, I think, like I said, the mainstream investors, the biggest, the investors who own everything in the market need the freedom to look at all the data that matters. And that's really to be a responsible investor, to execute on their fiduciary duty and their client mandates. They've got to have access to full information. So they're staying the course. They're talking about, don't take away my data, don't take away freedom to invest responsibly. But Stephen, you've been really talking to lots of our companies as well, and to the regulators. And
yeah, no, it's exactly like that. So we did a poll, Rob, and found that 75% of the people, this is average people, not investment professionals, when you ask them what those acronym ESG means, 75% don't know. But when you say to them, do you think a company should be profitable and care about its employees, profitable and care about its community, its water, its environment, over 85, 90% on both sides of the aisle say yes. So it is exactly as Rev said, that it's not supposed to be, companies aren't changing what they're doing. And in fact, they're actually doing more. They're investing more money in this transition, in mitigation. I was just on a meeting earlier today with electric utilities, and they're spending a massive amount on mitigation issues. So there's a lot being done. Some companies just aren't talking about it as much. So that's why we started this initiative, Freedom to Invest. So your listeners could go to freedomtoinvest.org. There's a lot of resources there about how to communicate it, and samples and resources that might be helpful.
Interesting. I would like to just dig into one thing there, Steve, that I find exceptionally interesting as I'm a bit of an infrastructure nerd. It seems as though there is an opportunity for a lot of electric companies, private and public, who need to make investments in their infrastructure right now to make them in a more sustainable way. Are they resolutely getting around that, or regulators getting behind them, et cetera?
well, there's the IRA, the Inflation Reduction Act, and the infrastructure bill. Those two pieces of legislation mean there's every incentive for the electric utilities and the investors standing side by side to make these big investments in infrastructure that are going to set the country up for the future, create good jobs, and really accelerate the transition. So, the investors at least are super excited about it. Stephen, did you hear that from the electric utilities this morning?
Yeah, I would say it's a mixed bag is the short answer. So there is more being invested in resilience and in renewables than ever before. And they're still investing too much in fossil fuel. I mean, to start a new project today, it's going to be a useful life of 30, 40, 50 years. It doesn't, we don't think it makes sense. So there is, again, if you looked at it compared to 5 years ago, there's the percentage going into fossil fuel. If you look at our country overall, where the banks are lending $1.7 for renewable projects compared to every dollar they're lending on fossil fuel. So that's a change, but it should be 4-to-1. It should, to get to where we need to go, there should be $4 for every $1. So it's progress, but it's not fast enough.
Right, and there's an appreciable difference in the fossil fuel impact from gas to coal to diesel and what have you, right? Those are also a big distinction in the, dollar range.
Absolutely. And they're exciting, carbon capture technologies and things like that. So I was at a conference the other day on this, and there were some exciting technologies. But again, the pace of what we're doing is faster than it's ever been. And the number of companies, the number of utilities, the number of banks, the number of investors that have transition plans but it's not fast enough to avoid, when I think about this, I think about it. I have a granddaughter who's 1 year old. When she's going to college, it'll be 2040. What's the world going to be like for her and all the rest of folks? And I'm very concerned.
Yeah, it's hard not to. I have some of the same concerns because I don't mind saying, I live here in New York City, which probably has real estate that's valuable enough to build a wall around, but most places aren't. It's a huge issue. It's something I know it's hard to intimate about your children, something terrible happening to your children or grandchildren. It requires a little bit of courage, but it's also rewarding. So I hope people will think about that. Let me break this down a little bit. I wonder how because you all have a lot of boots on the ground looking at the different state bills. So what are you all tracking that's notable right now?
Just to put it in perspective, so there was in the anti-ESG bills, there were a few in 22, but in 23, in the last legislative session, there were 167 bills filed, mostly in red states, and they're very restrictive, saying if you're a bank or insurer and if you have an ESG policy, you can't work with the state
Right.
or pension fund or things like that. So 167 were filed, and even though most were in red states, 80 were killed. Only 22 passed, and of the 22 that were passed, most of those there was negotiation, so they were weakened significantly. This year, the sessions are still going on. There's about 140. Now, of those, half of those were carried over from last year. So there's about 70 these are around new bills, but they've gotten broader. Some are dealing with insurance. There's one bill dealing with electric utilities, pension funds, banks, and others. But some of the more, I'll say, outlandish bills have died. For example, there was a bill in New Hampshire that we testified against and did not make it, fortunately, that said if your company has an ESG policy, it is a felony. Full stop. Felony. I mean,
Right.
that just doesn't, defies logic. So,
Right.
but the fact that that was even debated was somewhat challenging. So
Mhm.
there's a wide range. There's also a wide range on Capitol Hill.
Yes, I mean there's a wide range in most state houses also. This is what makes this so tricky and makes candidly your work quite valuable. I guess the other thing that I'm interested in is, sort of getting behind the curtain a little bit. How does all of the diversity of those bills, all of the changes that are being wrought right now, does that have an impact on your company's long-term planning?
So for Ceres Investor Network, I think, we are noticing that some of our investors are less likely to be spokespeople, so there's a hushing effect. People are talking about this green hushing, but not a shift away from the activity. And so, in spite of these bills that are pending, all of the responsible investors that we know and that we work with in our network are saying we got to keep doing the work and we'll find a way to keep doing the work. These attacks don't change the fact that we need to manage a set of risks and look for those opportunities, because that's our core business. We've got to keep doing it. So, but Stephen, you're talking to others, and in terms of shifting our work, maybe you've got your thoughts.
No, I think that's right. So this is, or I often refer to this as the best of times and the worst of times, in the sense that there's amazing things moving this forward. The IRA implementation, what a lot of investors are doing, the SEC, the 2 pieces of legislation in California for climate disclosure. The list goes on. So there's a lot of things that are historic, and putting them all together is great. But then there is a lot of defense explaining that we're having to do. Fight these crazy bills in some of the states I mentioned, explaining some of these things. So it is what we're finding, I'm oversimplifying, but companies are, as I said earlier, they're not stopping what they're doing, they're stopping what they're saying. And for us, we need to put more resources into explaining that. The other thing we need to do, which is different, is more resources into lawyers, because like once a regulation or law is passed, then it often gets sued. So the SEC has already been sued. State of California has been sued.
Record time. Yeah.
So that's something that, not that it's completely new, but it wasn't the same pace 10 years ago.
That was fascinating. Well, thank you all for being here and sharing these thoughts with the members. This is exceptionally interesting to focus on. A lot of them are working regularly with, well, something the Rev mentioned earlier, the jumping off point between when you have some data but not enough, where they're kicking their judgment in. And, I hope that they know that people are working on some of the bigger issues that might make that jump a little bit narrower in the coming years. So thank you for being here. And thank you all for listening into this podcast. We have a lot of ESG assets on our website. If you're a member, you can even dial in and find the Rev's video from all those years ago by logging into our website at cfany.org. Until next time, I'm Rob Rowan, and this has been Compound Insights.